Today in InvestTalk, I look at the Social Security COLA adjustment and how it will impact retirees. We then look at the market sell-off today driven by semiconductors, and we answer questions about Vale, Pitney Bowes, B2 Gold, and more. And at the end, the Chinese stimulus is a band-aid designed to prevent a crisis, not spur growth.
This is InvestTalk, independent thinking, shared success.
Now, my main focus point concerns this topic, the 2025 Social Security COLA adjustment, what retirees need to know. And I touched on this a bit last week, but there are two major positive changes coming to retirees in January. Now, the first is the COLA adjustment. We talked about it being 2.5% for 2025. So whatever your Social Security check is today, it will go up by 2.5% in the new year. Now, we know that most retirees, their actual cost of living doesn't go up quite as much as the overall, the average person, right? The average worker, just based on the mix of the types of goods and services that they utilize, okay? And so this 2.5% is nice. Now, it is down from the 3.2% growth that they saw this year from last year's check. Now, I don't know if you noticed, but when inflation remains flat or goes down, Social Security stays the same. So you never get Social Security cut, but it does go up with COLA. So that 2.5% will be nice, and the smallest raise, since the COVID crisis. Now, the next positive thing is higher earner test or earnings test. And I don't know if you know this, but you're allowed to work and collect Social Security at the same time. But if you do so before full retirement age, right? You take Social Security at 62, 63, which you probably I would say nobody. Few people should probably do, right? You want to probably wait to your full retirement age. But let's say you are taking Social Security early and you could earn too much money and have some of your Social Security benefits withheld. Now, what you have to understand is it is withheld and you will get it back later. So it's not like you're missing, you're not getting it at all, but you do get it withheld in the near term. Now in 2025, you'll get a little bit more leeway. You can earn up to $23,400 without having benefits withheld. That's up from $22,320 in 2024 this year. Now, when you go over that number, $23,400 next year or $22,320 this year, for every $2 you earn, you actually get docked $1 in Social Security, or get it withheld. Okay. Now, if you reach full retirement age and you're still working, you have a higher earnings test limit. Okay. So there's a different one between when you're younger, when you're below full retirement age, and then once you hit that full retirement age. So that number is going to go from $59,520 this year to $62,160 next year. And when you reach full retirement age, it's not 2 for 1, it's actually 3 for 1. So every $3 you earn over that number, you get $1 withheld. So that's a nice positive that you have a little bit extra cushion, especially those that work a little bit in retirement. More and more people are doing that because they feel still useful. They still want things to do when they get up, to move around. And frankly, the studies show that, it helps with longevity. It keeps your mind engaged, your body engaged. And for a lot of people, it's very, very helpful. But they oftentimes don't want to work jobs that push them over these limits. And the good thing is those limits are going up a bit next year based on that cost of living adjustment. Let's take a look at the market today. It was certainly a down day overall for investors. You had the S&P that was down 44 points, so about 2/3 of 1%. And it was pretty much selling throughout, and there's pretty good volume, to be honest with you. So this was a very interesting day, at least the most interesting red day we've had in a while. We've had little blips here and there, but this was above average volume. You're talking about higher volume than the last basically 2 weeks, all the last 2 weeks. And so that is something that I will continue to be monitoring. Do we get follow through to the downside? Now, a big driver of this downside was a report from ASML. They are a semiconductor chip manufacturing, chip equipment, company. And they talked about bookings being way down. So, is that a telltale sign for the future of the chip market? I'm talking about future. I'm talking about, more medium term, not necessarily long term. But, is the slowdown in chip demand here, right? With so much capacity built during the chip shortage and the demand for all these physical goods during COVID. And then you had the AI craze. Just so much capacity has been built up. Now, the history of the semiconductor space is over capacity, oversupply. Because what happens is they want to deliver the goods to their end user, right? The product manufacturer. And what happens is at some point, the product manufacturers slow, and that feeds into orders. And then suddenly all these chip producers have just too much capacity. And a lot of those chip makers have to sell at smaller margins. And so that's the history of the boom and bust cycle of the chip space. Now, we've been on an extended boom cycle. So does that mean there's could this mean there is a lot of overcapacity in the space that needs to come off and then, margins get hit? I think that certainly could be the case. I will be watching for this, but that was really the driver of today's sell-off. And large cap growth was certainly down the most. NVIDIA down 4.7%. Let's see what else. And NEO was down 3%. Intel down 3%. You had Trump Media down 9.6%. Let's see, what were some other big losers here? Yeah, ASML was down 16%. Lam Research down 11%. Applied Materials down over 10%. So a lot of the chip producers, KLA Tencor, also down 14.7%. So just so many companies that are in that chip manufacturing space that are starting to weaken. And that was really the story for today. You continue to have gold was up once again. So that just continues to power higher. You did have oil down as well on a report that Israel won't strike Iran aggressively. And that lowered the chance of a major escalation of issues in the Middle East. And so that really pushed energy down. And that was also a driver to the downside. But if you look at certain subsectors of the markets, there was still some strength. Utilities were up a bit. Let's see, consumer staples, those were up a bit. You had the bonds rallied a bit as well, and kind of a flight to safety. So once again, will this be followed through? Is it just a blip headline, and then tomorrow the market forgets about it, and we just kind of continue to grind higher? That's certainly possible. We do have the election coming up, so potentially throw some cold water on the market, depending on the potential outcome. Continues to be, I think, it's the increasing expectation that Trump will win. That just seems to be the odds are moving in that direction. The market is starting to price that in a bit, but we still have some ways to go, and we'll see what happens there. But that was the market today. First significant red day in a while.
Hi, Dave from Ohio. You got a question on Woodside Energy, WDS is a symbol, and it's a $32 billion market cap. See what your thoughts are and if it would be a good long-term hold. Thank you.
All right, looking at Woodside Energy, WDS is the symbol. It is a $31 billion market cap, so pretty large. Earnings are declining. However, in the industry in general, earnings are in decline. That's what happens when oil prices are down. Now, what you're probably looking at, though, is that nice, juicy 7.63% dividend yield. And as I constantly say, don't chase the yield. And this is a perfect example of that. Payout ratio is 142%. Its cash dividend payout ratio, meaning the percentage that it's paying out of a dividend of its cash flow, is 792%. So it's paying out nearly 7 times the amount of its cash flow in dividend. Is that sustainable? Is that dividend coming from anything that is sustainable? No. Because the only way to pay that dividend over a long period of time is to increase their debt level. And that's what they've done recently. Debt has gone from 4.8 billion all the way up to 5.8 billion. They've added $1 billion in debt in just a couple of quarters. That is not good. That is not sustainable. Now, is Woodside a bad company? No, I mean, they're still profitable. Free cash flow is still profitable, still positive. But if you look at its profitability longer term, zoom out long term, its return on equity is mid to high single digits on average over the last decade or two. That's not great. That's not great. And well, I think they can pay the dividend kind of near term because they have a pretty decent balance sheet. And that's not sustainable. It's not the type of business that you want to invest in. Okay. So I just think there's a lot better opportunities out there in the oil space. Yes, they don't pay a 8.6? 7.6. Yeah, they don't pay a 7.6% dividend yield, but they have better profitability, a better earnings trajectory. You're looking at Woodside at negative 5% earnings growth this year, negative 32% expected earnings growth next year. Let's compare that to I'm just pulling up Exxon because it's the biggest within the space, right? Earnings are supposed to be down 16% this year, but it's just a bounce back up 2% next year. So very different earnings trajectory. And you think a smaller company would have better earnings growth versus the mega name like Exxon, and you'd be wrong. And so I think you are chasing yield here, and there are much better opportunities out there. Now, I hope you've been telling your friends that our podcast is available in video form, which you can find every day over on our InvestTalk YouTube channel. And we get questions submitted via the comment section over there. And JG109426 says, hello guys, I would like your thoughts on ETF QQQM. And to me, this just looks like the Qs, okay? You're talking, but it's coming from Invesco. Let me pull this up here. If you can give me some color on this, I've never heard of this. It must be relatively new. They're both by Invesco. Overall, I just don't want exposure to overly exposed to mega cap tech. It's just starting to get weak. It's broadly pretty expensive. And so I'm not sure the difference between the Qs and QQQM, but either way, they both hold pretty much the same position. So I would not be owning QQQM. Let's pivot back to the InvestTalk voice bank. You know the number, it's 888-99-chart.
Hey guys, this is Trent from Long Beach. I have a question for Justin. Hey Justin, I'm getting closer to the minimum amount that is required by you guys to invest with you guys. And I'm looking for some details on a company. It's a gold company called, the symbol BTG. It's B2 Gold. They have a great dividend, so I'm trying to find out if it's worth getting more shares of stock from that company. Thank you.
All right, looking at B2 Gold, BTG is the symbol. And this is a small cap name, $4.2 billion market cap. They do have about a 5% dividend yield. This has been one of the largest dividend payers within the gold mining space for a long time. And that it's not necessarily terrible or good. As I've said earlier in the show and before, you don't want to chase that dividend. Now, if you took a return on equity longer term, it does tend to be higher than the industry average. So I like that. That's positive. And if you look at the chart trend, it is now in an uptrend. I like that. Earnings this year are supposed to be down 9%, but up 59%. Okay. And I think that's my biggest worry is that, if you look at the Newmonts of the world, the Agnico Ecos of the world, their earnings are going up dramatically this year. and their relative strength is in the 90s, whereas B2 Gold, you're at 56. So I don't think it's bad. It's not a bad miner to own. It has decent long-term performance, but I don't, even though it's an uptrend, I don't like the relative performance to the broader sector. If I do a ratio of BTG to GDX, which is GDX is kind of the large cap miners out there, the ETF. It's flattened out. It's basically been in line with GDX since May. That's somewhat of a positive, but historically it's been in a major downtrend. Now, part of that is the dividend, right? So I'm looking at price only. So I don't hate it, but I think there are better miners out there. This isn't the worst one. There's spectrums to this. It's not black or white. This is in that gray area, and it's in an area that I just think you have better opportunities. Now, if you already own a bunch and you want to add a bit of more diversity, smaller name, this is not a bad one to own, but I wouldn't buy it just because it's paying some dividend. Okay? Thanks for the call. Now let's go take a live call. We love these live calls, and it is coming from Armando down in Miami, looking at Pitney Bowes. Pitney Bowes, do you own it or looking to buy it, and what do you like about it?
I actually own it. I'm up about 40%, but it's about 3% of my portfolio. I'm wondering if I should just take the money and move on to something else or keep holding on.
Well, there's two sides to this. The technicals look fine. It moved up back in August from $5, called $5.50 or so. Hit a high around $7.50, and it's been kind of consolidating right around $7 since. It closed at $6.96 today. So from a technical perspective, it's just fine. Relative strength is 94. I have no issue with it. Now, that's probably because earnings are expected to go up from 4 cents last year to 36 cents this year and up to 97 cents next year. So if it's growing that dramatically, its profits that dramatically, and it's supposed to earn nearly $1, you're talking about a 7 multiple for something that's growing. That's pretty good. Okay. The issue I have, however, is its balance sheet does have a good amount of debt. Its free cash flow is not that great. And I think there's just a lot of issues, kind of with the business. Now, for everyone out there, what they do is they manufacture postage meters and mailing equipment and mailroom management software and services. Okay, so there's certainly aspects to that business that are in secular decline, shall we say? And so that's would make me say be ready to trim, be ready to potentially exit the position. But the technicals aren't really lining up. Like I said, it's just been consolidating here around $7 per share, and that is a positive. When something moves up and it consolidates sideways, that is just gaining power to go keep have a continuation move. And so that's why I probably wouldn't say sell it, because the technicals look fairly strong. Now, could you trim it here? Maybe a little bit, but I would have an out, and on the daily, that would be the 100-day moving average. So as long as it stays above the 100-day moving average, I would just continue to hold it.
Okay. I'll do that then.
Thanks for the call, Armando. That was Pitney Bowes, B-O-W-E-S. The symbol is PBI. Okay. Let's talk a bit about the China stimulus effort. And this is kind of the big story over the past couple of weeks. And Chinese economy has been sinking deeper and deeper into malaise for the last number of years, kind of since COVID, even since they released themselves from the zero COVID policy and all of that. And finally, Xi Jinping ordered a ton of interest rate cuts as well as other measures to put a floor under their growth. And I'll start off with saying my end conclusion to this is important to policy going forward, but mainly because it draws a line in the sand that the Chinese authorities are not going to allow the economy to just continue its malaise and stay well below the expected or target growth rate. Okay. Now, what this is designed to do, however, is more avoid a crisis than really spark big growth. And remember, the Chinese Communist Party has a contract basically with their constituents, which is it will make you wealthy and you allow us to remain in control. And if there is some sort of crisis, financial crisis, similar to like an '08 version, then that may be called into jeopardy, right? So in many ways, this was a bailout, very similar to what we did with the big banks back in '08, is underpin the system with a backstop. And bail out not the big banks, but mainly the Chinese municipalities, and many of them have been on the brink of collapse because they had been their debt levels were driven by the sale of land to build property. And when the property sector is in secular decline like it is now, there's just not a whole lot of ways for these governments to sustain themselves. And so that's what this is really about. Fending off a brewing financial crisis, de-risking the overall economy. Now, initially, markets loved it. Lower interest rates, as well as other measures that would boost the stock market. But since then, there have been press conference, another one recently that was relatively lackluster, didn't really give a lot of details. And so the market has been volatile since. And so the idea here, or the thought process here, is that this is a shift that is more tactical than strategic. Once again, providing liquidity for the local governments as opposed to really giving true stimulus to the overall economy. Yes, getting those local governments is important, or liquidity important, but it's not the end-all be-all. And they're encouraging brokerage firms, insurers, listed companies to tap the central bank or commercial bank funding to finance stock buybacks. So they want to excite the stock market as well, get those animal spirits going. Now, a lot of people feel like they're missing out, but if you look back in history, this has happened before. 2015. And there was an ensuing frenzy for stocks. And what happened? Well, it just rolled back over in late 2015. So the first 6 months of 2015, equities did really well in China, and then it eventually rolled over because there wasn't that underpinning of the real economy. And I think that's the issue here is what is this really going to do for the economy to spark growth? Yes, staving off a crisis is important, but it's not the end-all be-all. Growth also is part of their mandate, part of the promise to their constituents is that they will continue to grow the economy and grow their wealth. They did a pretty good job of that, but with its own set of problems, and those problems are coming home to roost right now. So, as of late, it's an interesting story, but there's not a whole lot of bite behind this bark. The Chinese Central Bank, the Chinese Communist Party, they are barking loudly. But because of this volatility and not a lot of details, it's pretty clear that this doesn't have as much substance as a lot of people are hoping. And so I wanted you to be aware of that and kind of where that whole situation stands, because you may chase performance, but ultimately, what is the fundamentals of the overall economy? And that continues to be very weak. Now, this is InvestTalk. Now, let's swing back to the InvestTalk voice bank for a question that came in earlier on 888-99-CHART.
Hey, Luke, Justin. Great show. I'm calling in from Southern California with a question about my rollover IRA. I'm retired and I'm 60 plus, and I would like to start pulling money out slowly over the next few years instead of all at once to avoid a big tax bill. My taxes will definitely be higher down the line. Am I a candidate for a backdoor Roth? Any help on this would be great. Thank you.
What I think you were talking about is not a backdoor Roth. It is a Roth conversion. And you are in the sweet spot. You just retired. I'm not sure your age. I don't think he mentioned his age. But you just retired, not earning any income. Okay, when you do a backdoor Roth, you have to have income, earned income. Okay, now backdoor Roth is when you put money into an IRA and then you immediately convert it. Okay, but even to do that, you need some sort of income. Okay, to qualify. Talking about earned income from a job of some sort. You're retired though, that you can do Roth conversions because you don't have a lot of income and you're probably in a low tax bracket. So there's a level that you want to convert a certain amount of money to stay below a certain tax bracket. Now, this is something we do for clients, which is do Roth conversion strategy in order to maximize the amount that goes into that Roth IRA at a low tax rate. We can kind of cap it at a certain level depending on, everyone's situation. But it also looks at your broader situation. What are your other investments? What type of earnings are those likely to have, et cetera? Do you have a pension? What about Social Security? What about all these things that play into that? So this is probably something you want to talk to either CPA, most likely a financial advisor like us that would develop a financial plan, look at your whole picture, and then recommend a certain amount of Roth conversions each year before you hit your RMDs. Okay, and especially before you hit Social Security. Now let's play 2 in a row whenever possible. Let's do that now.
Hey guys, this is Art from Tucson, calling in today after exploring some small and mid-cap value stocks. Found one that looks pretty interesting, Builders First Source, BLDR. Wondering what you think about it and if it's at a good price point to buy. I'll listen to your answer on the podcast. Thanks for all you do.
All right, looking at Builders First Choice, the manufacturer structural and related building products for residential new construction in the United States. And this is a name that business boomed post-COVID. They earned $2.08 in 2019. Last year, they earned $14.59. That's down from $18.71 the year before that in 2022. This year, supposed to earn $11.19, down 23%. But earnings are supposed to stabilize next year to around $12. Now, if they stabilize around $12 at $95 per share right now, that's decent, right? It's a decent multiple. I think that's fine. The problem is where's equilibrium line? Now, I like it. I like this company. Let me give you that clearly. It is a good quality name with good profitability. But where does the earnings kind of level out at? It's the analysts are saying $12, but is it really? Okay. And I think that's the big question. Now, free cash flow right now is $1.6 billion, but that's down from $3.6 billion in the second quarter of 2023. But the current enterprise value is $26 billion. So pretty good free cash flow yield there. Return on equity is 30%, but that the profitability is coming down. Return on equity was 55%. Now it's at 30%. And the technicals, they're okay. But you're not making new highs. Whereas if you look at like the ITB, which is the home construction index, which is a good proxy, right? Because they sell to home builders, that is near an all-time high. Okay. So I worry a bit about that relative performance. So it's a name that's actually in the database of names that we've been looking at, but it hasn't risen to the level in the industrial space of us to buy it quite yet. So I like it. It's just there's a lot of hesitation from where the ultimate earnings level out at. And that's why I would hold off on it and see if you can have a better technical setup, better earnings setup, as opposed to kind of continued deceleration of down 33% from its all-time high in earnings. Okay. Thanks for the call. Here comes another question now.
Yes, I was just wondering if you could say something about like buying a preferred stock. Thank you.
Well, preferreds, I don't love preferreds because they're in the middle of the capital structure here. And what they have is long duration. Remember, preferreds are pretty much indefinite. There's no maturity date. So they continue to pay you the interest rate. That's great. But what if interest rates go up and suddenly that yield on your preferred is not as enticing? I don't like that. And so there's a lot of duration risk. That's why if you look at PFF, which is the preferred ETF, it went from 39 in 2022 before 2021 when interest rates bottomed all the way to 28. Okay. Huge drawdown in that name because they're long duration assets. And a lot of people think they're stocks and they think of it as stock, but they don't have the upside. You don't get the upside if the business does great. You just get your coupon. So you don't get the upside of the common stock, but you also are taking a lot of duration risk, which you don't want in an inflationary environment. So I don't think that preferreds are great assets overall. Can you have a sprinkle of them here and there? That's fine, but definitely don't go overboard on them. There's another question that came in from the InvestTalk YouTube channel. I would like to get your opinion and analysis on a Brazilian company, Vale, V-A-L-E. I would like to start a small position under 1% in this company. What is a good entry point? Now, this is an interesting one, and this is a good lesson for everyone out there. And this is Vale. It is in a pretty consistent downtrend. And for everyone else out there, this is a company that is in the commodity space, mining and exploration. It's one of the largest in South America. It's a Brazilian company. And it's the world's largest producer of iron ore and pellets. And they sold off fertilizer, coal, steel operations to concentrate mainly on iron ore, nickel, and copper. So those are the main three. Okay. This was as high as during 08, before 08 the crash, it was at $44 per share. It went up in 2011 to $34 per share, but now we're at $10.79 per share. And the issue for this company, they pay a nice dividend. That's nice. Now, one thing you have to understand is that dividend is not, is it quarterly? March? Yes, it is. 3 times a year, it looks like. Yeah, not quarterly, but 3 times a year. November, March, and August. Okay, so 3 times a year. They don't pay quarterly, but they pay 3 times a year. But it goes up and down. That dividend goes up and down. Why? Because profits go up and down, and the Brazilian currency goes up and down because they're paying mainly in Brazilian real. So that's number one. You're taking a lot of currency risk here. Okay, they're also tied to the Chinese economy. Brazil tends to sell a lot of raw material to the Chinese, to the country of China. And so with China being up and down, Vale's earnings are up and down. And then you have political risk within Brazil that they could just take over some of their assets. It's happened before, right? The political situation in Brazil is relatively fluid. It's volatile. And so there's a reason why it's supposed to earn $2.15 next year and $2.07 this year. And it's trading around $10 and change. So you're talking about a 5 multiple. That sounds cheap, but it is trading at a discount for a reason. Now, I'm not saying you shouldn't buy it or own some of it. 1% of your position, your overall portfolio, that's not terrible. Not a ton of risk, but understand why it's cheap. Understand why it has a 12% dividend yield. Because it's cheap because there's a risk that the entire business can be taken over based on political whims. It's cheap because its earnings aren't consistent. It could easily go from making $2 a share this year to losing money next year or the year after. And that dividend paying 12% now can easily be cut. Movements can happen based on the real, right? Currency risk there. So there's a lot of moving parts here, and that is why it's trading at a discount. And then you head over to the chart. It's in a downtrend. It got a bounce because of the Chinese stimulus, but it bounced the 200-day moving average and rolled over again and didn't make a higher high. It made a lower high. So it remains in that downtrend. So until the technicals improve, I see no reason to get in. And a lot of people are going to be enticed by that dividend, enticed by that low P multiple, but it's been at a high dividend yield and low P multiple all year. And it started out the year around $15 per share, and now it's around 10 and change. So it's down 33%. So if you go just based on those factors, you're not in a good place. Okay, so I would not recommend Vale. I'm Justin Klein. This completes another InvestTalk program. We thank you for listening. We encourage you to tell your friends and family about our free podcast downloads, which you can find anytime at iTunes, Spotify, or Google Play. Be sure to rate and review on iTunes as well. And I hope you've heard that the InvestTalk podcast is also available in video form over on our YouTube channel. Just search InvestTalk with 2 T's. And remember, we can help you better understand your portfolio dynamics and calculate your investor risk number by going to investtalk.com and click on the portfolio review button. This is a free and confidential service. Independent thinking, shared success. This is InvestTalk. Good night.